Hello there. This is Mitch Goldberg. Thank you for joining me. You are watching Be the Boss of Your Money. This is a live episode where we will go over really important things: personal finance, investing tips, business, and other related subjects. The goal is for you to be the boss of your money, not your money becoming the boss of you. It's very easy for your money to become the boss of you when your investments don't add up and your expenses spiral out of control and you just get lost in bad personal finance habits that are very, very difficult to break. Today, we're talking about the Dow Jones Industrial Average versus the S&P 500. Ever since Apple announced their 4-for-1 stock split, the stock took off, the Nasdaq took off. The S&P's been setting record after record following the Nasdaq, and the Dow is getting very, very close. But what's really going on, and is the Dow Jones Industrial Average, America's oldest and seemingly favorite index, is it still worth following and tying money to? That's what we're going to talk about. What's the deal between the Dow and the S&P 500? And what you really should know, because you can't even talk finance without talking about these two indexes. Here's the quick intro. Stick around. See you in about 15 seconds. All right, we're back. Thank you so much for joining me. If we haven't met yet, my name is Mitch Goldberg. I'm a financial advisor with the wealth management firm Client First Strategy. I really do appreciate your being here, joining me today, taking your time. Whether if you're watching this in the live stream right now or in the replay, feel free to ask me any questions you may have. I would love to answer them. I love interacting with you, and that to me is actually the best part of this whole thing. I started Be the Boss of Your Money, I'm going to say almost a year ago, excuse me. But I started doing the daily streaming in February when stocks really started to go haywire and when the coronavirus was just starting to break out and oil was starting to plunge. And I decided, you know what? I've always wanted to have a live show. I've always wanted to share information. I always talk to people at around 4:30 about the market. So this was a great way to do it. Be the boss of your money, because I want you to be the boss of your money, not your money to be the boss of you. The Dow Jones Industrial Average has just announced some really substantial changes. And even though the stock market averages are always going through a series of changes, the committee at Dow Jones, they don't normally make the amount of changes that they made this time around. They just announced last night they're changing 6 stocks, 3 out, 3 in. It's a big change. It changes the way we look at the market and the way we judge things, because we always look at how the Dow does every day. And if something about that is significant changes, we really need to talk about that, because it's the most widely followed index, that and the S&P 500. So we're going to get into that right now. And I want to also talk to you about, is the Dow Jones Industrial Average even worth following? And does it really reflect its roots? Okay, so we're going to get into that. I'm going to share the screen. If you're a viewer of the show, you know we always start with a quick daily summary with perspective to get things started. The Dow down 60, the S&P up a little bit, up 12. Nasdaq had a pretty decent day. Tech stocks up. Small cap stocks, the Russell 2000, that's this green deal over here, that continues to move up a little bit. Had a good day yesterday. And the VIX, that's the VIX, that's the fear gauge. That actually typically goes down when the markets go up. That just means that professional traders are spending less money on hedging, and they're getting a little bit more comfortable that they're getting more comfortable with the stock market. It fluctuates day to day, so it's not something I put I don't put too much stock into it on a minute to minute basis. I just look at it maybe, once or twice a day, unless something really is crazy going on in the market. But generally speaking, it was up to about 90 at the peak of at the bottom of the bear market in the 90s. And then we wanted to see it trade below 30. And then the new line is under 25. And I think we need to see this get down to 20 for this rally to last. So enough of that. Let's talk about a couple of other things. This is the ultimate watch list every day. Communications led the way, followed by healthcare, followed by technology, and the bottom of the pack are energy, utilities, building materials, industrials. Industrials were off a little bit today. That's the XLI. What you're looking at here are the major sectors. There are 11 sectors of the U.S. economy, according to Standard & Poor's. And industrials, financials, and energy are the ones that you want to see lead the way. They had a good day yesterday. So the fact that energy was off a little bit, no great shakes. That was basically dragged down because ExxonMobil was booted from the Dow. We're going to talk about that. Industrials, XLI, okay, not terrible. We had a good day yesterday, and financials had a good day yesterday, and they're still holding up. Overall, today was a mixed day. It wasn't a bad day. Wasn't a great day. It was okay. Just the kind of day I like. It gives you a little bit of room to breathe and catch your breath a little bit. All right, so let's just boot this one out, and we're going to go talk about the key subject here. All right, what is the Dow Jones Industrial Average? Why is it important? So let me start this again with a full screen. What is the Dow Jones Industrial Average? Why is it important? And does it truly reflect the state of the industrial part of the U.S. economy? When this index was first put together by Charles Dow and Edward Jones in 1896, the United States was basically an industrial economy. Sure, it was very agrarian as well, but the Industrial Revolution was well underway, and the United States became a manufacturing powerhouse. Industrial stocks are also known as manufacturing stocks. They're also known as the smokestack stocks. A lot of names, but basically companies that actually manufacture things. But over the years, as manufacturing has moved overseas and the United States has become more of a service economy, a technology and communications centric service based economy, industrials really do take up much less space in the economy. They're just not quite as significant as industrials were a long time ago. So without giving you a whole history lesson, because I don't think that's what you're here for, I don't really think that the Dow Jones Industrial Average is particularly useful when it comes to judging and evaluating the industrials. There is a much better way to judge the industrial part of the economy. We're going to get to that in a second. I'm not saying the Dow Jones is a waste, but the Dow Jones definitely reflects the economy, the U.S. economy, as it is today. So maybe it should be called the Dow Jones U.S. Economy Average. Okay. The S&P 500 is a little different. The S&P 500 is considered much more representative of the U.S. economy. But the big difference is a few things. The Dow Jones Industrial Average, okay, is 30. The Dow Jones Industrial Average, okay, hold on a sec. The Dow Jones Industrial Average is 30 stocks. It's an index of 30 stocks. S&P 500 is an index of 500 companies. Actually, there's, I think, like 503 or 504 stocks in it because some companies have more than one class of shares, like Google. Alphabet has Class A shares and Class C shares. But the point is, it's 500 leading companies of the leading sectors of the U.S. economy. And I think it's a better indicator of the stock market. not necessarily a better indicator of the economy. The Dow Jones Industrial Average is not doing as well as the S&P 500 this year, but just about getting very close to record territory. And by the way, but lately you've seen the Nasdaq has been hitting record after record, and now the S&P 500 is hitting new records, and now you're seeing the Dow Jones. It's just a few percentage points. I think it's like 1 or 2 percentage points away from its all-time high. So clearly we are out of the bear market at the moment anyway. So the other thing is the S&P 500 is market cap weighted. Market cap is just simply saying, a fancy way of saying the total value of a company. So if a big company like Apple, which is the biggest, over $2 trillion market cap, that'll have a much bigger impact on the S&P 500 than, let's say, a smaller company like Caterpillar. So since the biggest companies are all in the S&P 500, the bigger companies have a bigger impact. It's different for the Dow. If a company is $1,000 a share in the Dow Jones Industrial Average, but it's only a $100 billion company, and a $500 stock is a $2 trillion company, the $1,000 stock will have a bigger impact on the Dow Jones Industrial Average because it's price weighted. The biggest impact on the Dow Jones Industrial Average is the current trading price of each of the 30 component stocks that make up the index. Whereas the S&P 500, it's based on the market cap weighting. So what happened basically is this, and we're just going to share screen again. This is really important, folks. I hope I'm doing this justice to make the points here. Okay, but if you take a look at this, all right, basically Dow Jones is changing. It's still 30 stocks, but Apple is a high price stock, so it's had a really big impact on the Dow Jones Industrial Average. If it wasn't for Apple, the Dow Jones would be considerably lower. But what happened is technology is currently about 27%. You see this 27% of the Dow. It's going to go down to 20% after Apple's stock split because it's going to be, a lower price stock. So therefore, so technology is going to have a lower weighting in the Dow Jones Industrial Average. A company called Salesforce.com, which I'm very surprised is being added to the Dow Jones, that'll bring the tech weighting to about 23%. Right here, about 23%. You see that? I don't know if you can see that on your little phone screen there, of technology in the Dow versus, well over probably about 27, 28% or 29% in the S&P is tech. And by the way, a lot of the tech in the S&P is not even counted as tech. Communication stocks, if you add those, you get a much greater percentage of technology in the S&P. For example, Alphabet, which is Google and Facebook, and Netflix are communication stocks. If you added those into the tech sector, the tech sector would be what, 35% of the overall S&P 500. So you could see that Apple is really being pushed around by tech stocks, which happen to be doing well now. So that's why the S&P has been doing so well. All right. So having said that, there are 30 stocks in the Dow. Of the 30 stocks, okay, my screen goes a little slow when I'm live streaming, so I'll just cut that right out. The stocks that are being kicked out of the index, out of the Dow Jones Industrial Average, are ExxonMobil, which I believe up to now is the oldest company in the Dow. It used to be called Standard Oil of New Jersey, believe it or not. But that company is being kicked out of the Dow, one of the oldest companies in the country. I think it's been in the Dow probably in one form or another for about 100 years. Pfizer, which was added in 2004, is getting the boot. So those are two stocks right there. The other one is Raytheon Technologies is getting the boot, and the replacements are Honeywell, another industrial, Amgen Healthcare, which drug company, which is replacing Pfizer, and Salesforce is being added. So I don't really. I could see Honeywell being added to the S and to the Dow Jones because it's such a big industrial company. I don't see why you'd have Amgen replace Pfizer, except that Amgen is a higher price stock. See, Dow Jones Industrial Average, they want to have higher priced stocks in the average because it makes the average go higher. Okay, so that's kind of how it works. It's not really. I don't think it's the greatest way to judge the economy or the stock market just by the Dow. In other words, in the S&P 500, bigger has a bigger weighting. Bigger is more impactful, but it doesn't necessarily mean better. With the Dow, a bigger price is a better stock. I think the Dow just really, when a stock gets down to a lower price, they basically boot the company. They kicked out Bank of America a long time ago. Obviously, GE is a single-digit stock that was kicked out. GE, I think, was the longest of any stock in the Dow. GE was kicked out, I think, a few years ago, but that was like the last original Dow stock. Okay, so we've got a couple of other things. By the way, Salesforce.com is up 11.5%. It's up $26 a share after market trading because it came out with a blowout earnings report. Too bad Salesforce didn't make it into the Dow before this news came out, because then the Dow would have just gotten a nice pop from this. But it's not the way it works, and just it is what it is. Salesforce is an amazing company. So I'm glad it's being added to the Dow, but I'm surprised because there are other very big technology companies that have higher stock prices. I would have thought Google would have made it into the Dow Jones Industrial Average way before Salesforce.com would have made into the Dow Jones Industrial Average. By the way, I do see someone out there. If you have any questions, please ask. Okay. Yes. Carlos is out there. Hey, buddy. CRM, that's the ticker symbol for Salesforce.com. CRM, customer relationship management software. Yes, that is, to me, it's a shocker. I tend to agree with you. I would have thought Alphabet would have gone in there first. So that's basically it. I want to give you a better way to judge the industrial average. Let's say for a second we get rid of the Dow Jones Industrial Average. Just put that aside. And let's take a look at a different sector. You see this? This is the XLI. That's in my main dashboard. I always show you how the major sector ETFs do every day. This is the XLI. This is the industrial sector according to Standard & Poor's 500. If you look at the stocks, Union Pacific, UPS, Honeywell, Lockheed, Boeing, 3M, Raytheon, Union, UPS. Well, one's price, one's weight. Let's just go by weight, okay? Union Pacific, Boeing, Caterpillar, John Deere and Company, GE. All right. These are the biggest holdings, okay, in the XLI. This is basically XLI. That is the XLI. The XLI, that is the sector ETF from the Spider sector ETF that follows industrials. To me, is a much better way to gauge the cyclical / economically sensitive / smokestack / manufacturing part of the U.S. economy. The Dow Jones Industrial Average has companies like Johnson & Johnson and Disney, not disputing that these are great companies, but they're not industrial companies. It's not really the industrial average anymore. The Dow Jones Industrial Average, in my opinion, should just change its name to the Dow Jones U.S. Average or something. And the XLI should just be your gauge. So the bottom line is this. I think we all know this, that the S&P 500 is really the gauge that we all use to judge the U.S. stock market. It's a market cap weighted index, meaning bigger companies have a bigger impact on the direction and price movement of the S&P 500. So since the big tech stocks are also very well suited for the work from home, stay at home environment that we're in, you like Amazon, Netflix. Okay. We talk about these stocks every day. I'm so sick of talking about them already, but when they get bigger and this environment favors those companies, it just makes them go up more, and they're bigger companies. So they're having an outsized impact on the S&P 500. A lot of people are worried about that because they feel the breadth of the S&P 500 is too narrow. There's too few companies pushing it to record highs. Look, I'm not saying you should trade that information. I think valuation, whether too high or too low on a stock or a sector, in my opinion, it's an awful way to make investment decisions because I don't think it really works as a timing tool. Right now, our economy is basically a tech-centric economy. But having said that, the Dow Jones Industrial Average with companies that are going into it like Amgen and Salesforce.com, and it has Disney and it has Johnson & Johnson, it's just, in my opinion, not really an industrial average. And the better thing to do is to follow an ETF. The symbol is XLI. That's the spiders from State Street, the spider industrial ETF. And that is a much better way to go and a much better way to judge the overall strength of the economy. While I have here, I'll see if I could possibly get a quote on it, because again, when you're live streaming, your computer has a tendency to work. Oh, it came up really fast. I was just going to say your computer has a tendency to go a little slow, but let's just take a look at this. Okay. This is the XLI. Okay. It closed at $77.73. And let's just take a look at the year high and low and year to date performance. All right. The 52-week high is 85. It's off year to date 4.5%. It closed today at 77. So still down on the year, well off its highs. And, but that gives you a better gauge of where things are than just looking at the S&P 500 for the manufacturing economically sensitive part of the economy. The S&P 500 is a better gauge to judge technology, and the Dow Jones Industrial Average it's a good way to judge the overall health of the U.S. economy, including lots of other sectors. But when you want to isolate and pinpoint a sector, you go with the ETF XLI, and that's about it. That's my story. There's so much money tied to these averages, so many ETFs tied to these averages, and you can't even hear a business report on TV or on any website without hearing about the Dow Jones Industrial Average. So I thought I'd make a live stream about it. And so what's going into it again? Honeywell's going in, Amgen and Salesforce. What's leaving is Raytheon, Pfizer, and ExxonMobil. So Chevron is the last energy stock in the Dow. Considering that our economy runs on oil, energy, it's kind of strange to me also that ExxonMobil would get the boot. And if ExxonMobil was, $200 a share, it would probably stay in the Dow. But Dow Jones, the company Dow Jones and S&P, they want bigger, higher price stocks. Not necessarily bigger companies, but definitely companies with higher price stocks in the Dow. Okay. Hey, James. You're very welcome, and I appreciate that. Thank you so much. Thanks for watching. And James is in Melbourne, Australia. Follow him. He's on LinkedIn. He's a financial advisor in Melbourne. And Cindy's out there. Cindy's my little baby cousin, who's really not a baby, but old habits die hard, right? So nice to see you, and you're very welcome. It's my pleasure. All right, gang, that's about it. I'm going to head out for the day. Got some things to do in the office. Thank you so much for watching. I'll be here tomorrow with a special guest, Wendy Goydell. She's an estate planning, trust and estate attorney, and we're going to have a lot of important things to talk about. So please tune in. All right. Speak to you soon. Speak to you tomorrow.